Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers and economic data from last week and this week. I'm also going to go over our favorite three asset classes and how we are positioned on the short term for equities and on bonds. So let's jump on in.
Okay, let's look at a new graph this week. We're going to look at the major asset classes and their performance on a weekly and on a year-to-date basis. After 3 weeks of being down on the equities, finally had a little rally, so the equities were positive for the week. And we had some profit taking on the US dollar, the aggregate bond, and on commodities. But let's go ahead and zoom out and look at the year to date. The US dollar and the commodities are the only two areas that are positive year to date, while we have the bonds here down 10% or more. And then we have the equity section right here, which they're down 15% or more. Okay, and then of course we have Bitcoin, which is in a major correction down over 53%. Okay, let's go over the top three market movers for the week, September 12, 2022. We're going to look at a little bit of the economic data from last week and this week. And number two, we're going to look at jobs and layoffs. And number three, we're going to look at the chart of the week, which is commercial real estate. Okay, last week we had the ISM non-manufacturing number for August. It was estimated to come in at 55.5, and it actually came in at 56.9, which was expansionary. So not recessionary, but expansionary. So that's a positive, and we touched on that last week, and it was a positive number. The ECB came out last week and they raised their interest rates by 75 basis points. They lifted their deposit rate from 0 to 75 basis points and their main refinancing rate from 0.5 to 1.25, which is their highest level since 2011. Now, they did not mention anything about quantitative tightening. Okay, where we are actually over here in the US are quantitative tightening or pulling back some of those bonds. They haven't mentioned anything along those lines. So, and that is why, or while they have inflation still going up over there, where ours, which we'll go over in a minute, has probably peaked, theirs is still going up. So we shall see who blinks first or who's ahead of who or who's really behind. But they still have some major work to do over there in the Eurozone versus what we're trying to do over here. All right. And to bring to that point, Tuesday, we have the Consumer Price Index, which is our look on inflation, and our August estimate is at 8.1. So how does that look? Well, if you remember back, we had inflation at 8.5 in July, and we peaked at 9.1 back in June. Okay, so it's about 1% lower, but we've got to continually see these numbers going down on a longer term basis, and just 2 or 3 months isn't going to be, oh my goodness, they're all done and everything's fixed. They've got to bring this down quite a bit. And if that number is correct, we're only still at 8.1. Okay, but the thing to watch and the thing that we've got to keep an eye on tomorrow and what they're going to be looking at is we've got to see a negative number month over month outside of energy. Okay, we know that energy and gas prices are going down, but we've got to see it in food, we've got to see it in goods, and we've got to see it in services. I think the Fed would really like to see all of those on a month over month to go down. But if they were just to see one or two, I think that would be a positive in the Fed's mind. And that means that what they're doing is working, which might change their mind, but most likely we're at 90% odds that we're going to have a 75 basis point rate hike next week. So that's where we stand today. This number may change that a little bit. All right, let's go over number two. Let's talk a little bit about layoffs, okay? They have been rising over the last 4 to 5 months here in the technology sector, okay? So that is something, yes, A lot of those companies thrived during COVID, and now since we're going back to work, they're starting to lay off people. But there's another area that's we're starting to see some layoffs and temporary freezes on hiring, and that's on the mortgage side. And yes, that makes sense because interest rates are going up. So the demand for refinancing or even just purchasing a new home have declined. Okay, so we've got to make sure that this doesn't continue to spread and go on to other areas. So this will be something that we've got to keep an eye on moving forward. Hopefully these things also kind of rotate or roll over, and we see the layoffs kind of diminish. All right, so our chart of the week is commercial real estate after COVID. Okay, and so what this graph shows, it shows a lot of these major cities and the percentage of office space that is currently in use. Okay, and if you look at this black line, this is the actual national average. And the ones that are doing a little bit better, we're here based in Dallas, and Dallas right now is at 52%. Just here over the past month or two, we've started to see traffic showing up again, actually cars on picking back up and people going back to work. But I also know a lot of people that are still working from home. Okay, so we're still just barely above half. Okay, and all of these are Texas. And if you look down here underneath the average, you're seeing California and New York and Chicago, a lot of these large cities that are still just barely a third or maybe 40% back to work. Okay, and what's interesting about that is the projections now, if they don't start getting back to work, the real estate valuations for these large buildings are going to start to come down precipitously. And so we've got to keep that in mind. And also the property tax for these buildings are the most for these cities. They're the biggest source of tax revenue. And so if these companies start selling them, they can't rent these things out, their tax revenue for these cities is going to come down, which means a couple things. They're going to have to start laying off people, or they're going to have to start cutting services, which neither one of them are a good thing, or they may even start raising taxes to help bring in some additional income so that they can pay out. They were already having issues prior to COVID. Now this is drastically affecting them. So we've got to keep an eye on this. And that is why you see JP Morgan and other large companies saying, get back to work. We need you back into the office. No seat, no job. You're starting to hear that now. So we should possibly see these numbers come back up. And so that's why it's the chart of the week. All right, let's go over the top 3 asset classes on a long-term basis for September 12th. Well, guess what? We are still on defense. There has been no change. We still have T-bills, US dollar, and utilities in the top 3. So no change from last week again. All right, but let's look at the fixed income side or the bonds on a short-term basis. And if you remember 2-3 weeks ago, again, we look at this every week. We've got to keep an update on this. We went back to protect mode. We started to nibble and started to buy some bonds, and then they rolled right back over. And we said, okay, well, the Fed is going to raise interest rates. That is going to affect bonds. And they started to sell off, and we went back to protect mode. Okay. And again, this is the second kind of bond market rally that we've kind of seen, and then since have sold off, and bonds are down 11% year to date. Okay, same goes for the equity side. They had a nice little run here through July and August, and then they sold right back off, and we went back to protect mode for this third time this year. And now they've bounced. These little yellow zones, again, I've like explained in the videos before, they're support and resistance zones. And so the market came down last week and stopped right at that support zone. It bounced right off. and now it's coming back up to this resistance zone. And so maybe this week we'll get into this area, and unless there's some news driving it forward, it will either break out or come back down and test the support level again. But we see some choppy trading here probably over the next month or so until we get some definitive direction on which way this market's going. But again, multiple bear market rallies as this market has gone down, and the equities are down 13.8 through last Friday. Okay, that's it for this week. Thanks again for joining us. Our next update is Monday, September 19th. And as always, please continue to subscribe to our channel if you haven't. Comment, like on our videos. Again, we do this for you, so your comments are appreciated. So continue to have a great week, and we'll see you next week. Thank you.